Welcome to the 3-Edge Week in Review for the week of November 18th. I'm Fritz Folts, Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3-Edge Asset Management. And today, Steve and I will discuss the widening gap between the competing visions of the bulls versus the bears on Wall Street when it comes to the future direction of the U.S. equity market. For example, immediately following the election, it appeared that the bulls were in charge, at least for the first week. However, then, during the following week, the U.S. equity markets gave back much of the post-election run-up in U.S. equities. So let me bring Steve in here, and let's get into this conversation. So, Steve, it certainly feels as though there is a wide difference of opinion out there about the future direction of the equity markets, particularly in the U.S., as we head into the final 6 weeks plus and then into 2025. So why don't we begin by having you describe, all right, so what's the bull case for the U.S. equity markets heading into next year?
So at least in the short term, the bulls have a lot going for them. We have tremendous positive market momentum. And as the market keeps going higher, it draws more investors into the market to take advantage of that positive trend. That forces the market to go yet higher, and it's a self-reinforcing virtuous cycle. And it's been going up for a while, and the election was another boost in the bulls' favor. Next, there is a thought about how corporate earnings and productivity might be rising in the future at an even greater rate if we get deregulation and tax cuts as proposed by the president-elect. Next, we have had some Fed rate cuts, and there's some expectation that that might continue, and that's been very positive. Fourth, we have had what many call a Goldilocks economy, an economy that's growing at just the right pace, not too much to cause inflation to rebound, not too slow to worry about recession, but just right. And again, we're going to get a lot more news about deregulation and corporate tax cuts between now and into the inauguration and beyond. And that will always be a positive news burst that will make the bulls feel like celebrating.
Well, that's a good amount of positive factors. So now let's examine what has the bears on Wall Street so concerned about the U.S. equity markets.
So I would say there are a number of things. One is that by certain measures, this is one of the most overvalued markets in history because the rally has been going on for so long, and because the price per share of the S&P 500 index, which is a great proxy for U.S. stock market, because the price per share has been growing at a much more rapid rate than underlying earnings and sales, the bears would say that's just not sustainable. Now, they would admit that past market bubbles seem to go on and on and on, much further than valuation would suggest, or much further than even logic would suggest. But eventually, when they do turn over, when the bubble bursts, it's often a very deep correction. And so that's one thing that the bulls are worried about. Secondly, while the Fed has been cutting short-term rates, long-term rates have been rising. And they've generally been rising since the summer of 2020, but especially lately, they took another big leap upward after the election. And this has surprised a lot of bond investors. And rising bond yields are not the friend of the stock market. Third, there's been a lot of notice of insider selling. Corporate executives, they're taking advantage of this run-up to sell stock. And so that makes one wonder, well, what do they know that other investors don't know? And then fourth, there's a growing fear of a threat that we're going to enter a tariff war. And while the idea behind tariffs are to protect the American worker and the American company, what we know from history is that when a country introduces tariffs, more often than not, there's retaliation from other countries. And it's a lose-lose situation where you get a tariff war, it turns into a trade war, might even turn into a currency war, and all parties lose. The economy slows down, inflation goes higher, because of the higher tariffs, and you end up with stagflation, which is bad news for stocks and bonds. So that's what the bears are worried about.
So that's a good number of factors there on the negative side. So, as always, my final question is based on the difference here, the difference of opinion between the bulls and the bears when it comes to the outlook for U.S. equities, then how should investors think about their positioning, their portfolios in this type of environment?
So here's our perspective that when you have a long rally, and despite an overvalued market, sometimes the steepest part, the most productive part of the rally is right near the end of the bull market, and you get some really steep gains. And right now, our models are indicating that these positive factors are enough to overcome some of the negative factors, but in the short term. So with a short leash, we are allowing our portfolios to have equity allocations. And more recently, we've allocated relatively more to U.S. despite the overvaluation and less to international because of the threat of tariffs hurting international more than U.S. And because the short-term momentum can continue for a bit more. So we're not at our maximum equity allocations by any means, but we're far from our minimum. And that will allow our portfolios to continue to ride the short-term wave. So we think a lot of the bullish factors are very short-term in character. And a lot of the bearish factors are intermediate to longer-term in character. So I say a short leash. We are watching every single day for those factors and those signals and for our models to tell us when it's likely that this rally will end. And we'll be not hesitant to be a lot more defensive because we know that when bubbles like this burst, the way down can be very far, and we don't want to suffer the big drawdown. And we think that the market being so overvalued is not at a normal risk of a drawdown, but at a much higher than normal risk of a drawdown. It's just a matter of timing.
Excellent. All right, good. Well, thank you, Steve. So it's going to be very interesting how things pan out then in the final weeks of 2024 and heading into next year, because it certainly seems as though there's a great deal of uncertainty ahead for the markets. So that will do it for Steve and for me for this week. We'll return next week with another edition of the 3 Edge Week in Review. As a reminder, all our videos are always available on our 3 Edge YouTube channel. And if you know someone who might enjoy or benefit from these videos, please feel free to share them. In addition, if you enjoy watching the videos and find them helpful, please also consider subscribing to our 3 Edge YouTube channel. We would be most appreciative. So until next time, on behalf of Steve and everyone here at 3 Edge, thanks for listening.